And as always, we're going to be looking for accurate context, good risk management, and always exercising good patience.
Everybody who's traded has gone through periods of time where their strategy hasn't worked.
Where if not a hard stop, you should reevaluate the trades you're in based on time.
That's what we're here for, is to put ourselves in the best success. A trading routine does that, builds that habit, lets you know what to work on, what to reflect on, and what to improve on the next day.
Hello, everybody. Welcome to the Limit Up Podcast, a presentation of Top Step. I am Jack Pelzer, joined by John Doherty today. John, always a pleasure to have you. Look forward to hearing what you think about some pretty good things going on in the equities right now. How you doing today?
Pretty great, Jack. Thanks for having me again. What's going on with Danny? Using up all his vacation time?
Well,
First
today,
month of the year?
Yeah, we finally have snow. He marks it around wherever there's snow, right? I'm going to turn my headphone volume up a little bit. I guess he got the alert from, I don't know, Santa Claus or whoever does it, and he's out snowmobiling somewhere. So
Good for him.
Given the winter we've had, it's cold now, but I'd watch the thin ice, Danny, because it's been a warm one so far. So yeah, with that, Dan's away, and maybe that's good stuff for the markets. Going on the back of Jerome Powell's meeting and announcement from the Fed yesterday, which saw stocks rocket up eventually, because we all know it dives both ways. We'll talk about that a little bit. Today's overall theme is going to be, well, we just finished up a more general three-part series about our prep, trade, reflect methodology. And now let's put it to use. So we'll start by doing like a pseudo recap today. Doherty, how close have you been looking at like the ES today?
Not religiously, but I am looking at it. I'm watching
Yeah,
it.
well, let's look at it together. I've been seeing a few things. We're up quite a bit, obviously, as of right now, about 64 points, 492. So that's 3.9% up in the NQ, 1.5 in the S&P. And what that has to do is with earnings from Meta yesterday, something I would not have thought I'd say in years, but it's crazy to see after hours a company the size of Facebook be up 20%, I think it was, right after hours on the earnings release. And that is what is kind of driving the NASDAQ. It's sort of, if they can do it, we're all home free, or at least that's the vibe I get. Besides that, the thing that I've been watching as far as the ES finally happened today, we have a golden cross. The 50-day moving average on the ES has officially surpassed the 200-day moving average, which is something I look back on. For those of you who are the Michael Burrys out there.
What type of moving averages do you track? Simple, exponential, hulls? Any specific kind?
I think they all have their place, but I think for just the classic, I just use simple for like the 5200, just because I assume that's what the most people have in there when they're talking about like these crosses. But obviously, like if you're doing trends and stuff, there's definitely places for, I'm more familiar with the exponential, but I know people that use the whole as well.
Yeah. I definitely prefer the exponential on the shorter terms. Anything under a 50, I'll look at an exponential, but from the 50-day beyond, simple moving averages are what I look at also.
Just so everyone out there understands the math of the exponential moving average, it just more heavily weights the more recent parts of the more recent time frames you're doing it for, right? So it could still incorporate something big that happened 8 days ago. So what days do you use that are under 50 with that exponential?
2010, maybe a 5 if I'm really trying to trade some short-term positions, real quick in and outs. But that's it. I don't get too creative with them.
Yeah. So, and I don't get creative at all with the 50 and 200, but something that's interesting. Well, I'll be looking very hard these next 2 days. Then we'll get to the Fed. What has happened with the 50-day moving average crossing the 200? We'll see if it holds. That the entire time in both the Great Recession, like that stock crash, and the tech bubble, the 50 never crossed the 200-day to the upside the entire time until the bottom was in. Now, it came very close, and that's why I say it's important that it holds it. We're literally like, I just want to talk about this, but we're just an inch above. Like right now, I have the 50 days at 39.70, and the 200 is like 10 points below that. I want to see some consistency here because it did during the tech bubble. It did touch it, and I zoomed in. The data so far back, I couldn't tell if it maybe hit it. So I'm just giving that as full disclosure. But it would be unusual in something like this for it to cross and then continue to the downside.
Right.
Yeah.
There's a lot of momentum pointing higher right now. I mean, the ES, I'm just glancing at the chart right now. We're looking at 8 higher closes out of the last 10 trading sessions. We broke through highs from last September. I mean, there's a lot of signals pointing higher right now.
I think you're seeing a little bit of the beginning of a vibe shift.
Mhm.
And that goes into a lot. And the title of this episode is the bottom in. And we'll mostly talk about the Fed. But I saw a good tweet yesterday. And let me see if I can find this really quick. You know, we can have some patience. I hate to misquote or not give people what they think. It was basically, okay, so I saw this tweet said the financial markets are loosening. This is from Joe Weisenthal. The financial markets are loosening, economic growth is accelerating, and the Fed is not trying to short circuit the move. The onus is on the bears to tell me what changes. So we've been in this whole cycle of Fed hiking rates that has brought us into this downward trend, you know, to combat the inflation. And for all you out there that are trend trading, like day traders and such, the onus has been on the bulls for this past all 2022, right? The idea was you wanted to sell the pops. Now, the Fed hiked a quarter point yesterday, which was expected, gave some conflicting things about going forward like they always do. But they are definitely signaling that they're pretty much at this point signaling where they think their terminal rates are. And then it'll be kind of like how long they hold it. But there's a lot of good economic data out there besides that. You know, we talked about the Meta earning beat, but unemployment's low. There's a lot of good things coming out of the home builders are all at 52-week highs, stuff like that. There's a picture emerging that things might be okay. And now when things are okay, the historic mega trend of things like stocks are to continue going up. Now it might be on the bears to be like, what is the bear case? So because you're JD the Dancing Bear,
yeah,
you and Michael Burry, who we're mentioning Michael Burry because Michael Burry is such a weirdo. Like, obviously he made a lot of money, but he's seriously one of the weirdest friggin' guys. I mean, just for a little background for people, I don't know if they cover this in The Big Short, but he essentially, you know, left the medical school or profession because he like fell asleep during a procedure because he was like trading all night. So everyone knows about The Big Short stuff, but if you don't follow him or see him on Twitter, he is one of the most enigmatic figures. He deletes all his tweets and then just once in a while just comes out with something. He goes by the name Cassandra, which is I'm not good with my mythology, but it was a fortune teller or someone who's predicting something is like a Cassandra. So it's pretty it's a pretty what do you call it? That's a pretty bombastic name to have. But before this Fed meeting 2 days ago, he just tweeted out sell, period.
I'm gonna have to start following that guy. I haven't checked out his Twitter feed in quite a long time. But I mean,
you can't see the feed because he deletes everything.
But I get what he's saying. It seems like the theme since Wednesday's rate hike is traders really just think the Fed is wrong on this. I mean, they're still opposing this sort of hawkish stance for now, meaning that it sounds like they're still in favor of another rate hike, maybe another 25 basis point rate hike in the next meeting in March, while the street is really taking the complete opposite stance right now. You know, we saw a 25 basis point rate hike yesterday and stocks rallied, bond yields fell,
Well, they value all the classic things you'd see. And like always, we've said this before. This is why you shouldn't really trade around like the Fed releasing number. It seems, and this is just anecdotal, I'll go back with a spreadsheet and figure it out sometime, but it always whipsaws. It always goes, I feel like it always goes one way and then never follows through. It goes the other. Like on this number, because it was so expected, not a ton happened, but it erased all the days. It like put in new lows. And then during the presser, off to the races. I think because he was saying good things about, he wasn't, it's so funny to hear them up there being like, we got to get, unemployment up. But he was a little bit softer on that. And what you said earlier, it's like, yeah, they're not pricing in what the Fed says it's going to do, but like the difference between them is narrowing. I mean, you can't, per my, good friend, Michael Burry, it's like on the macro, like in the whole scale of things, it's like, how much will it matter a year from now if they hike 0.25% at the next one and 0.25% in May versus just 1/4%? Like how long they hold things will matter, but it's like we're down to the 0.25%, right? Most of the race has been run here. So yeah, what are you looking for? I feel like we always say, the CPI number is gonna be spicy.
Well, I think the next meeting in March we'll definitely see a 1/4 point hike. I was doing quite a bit of reading about this right before we started, and reading a few obscure articles, and there are people out there actually expecting a rate cut before the end of the year also, which I wouldn't put too much faith in that. I mean, like you said, we're starting to taper off on hikes right now, so we'll have to likely span a period of no hikes or cuts for a while. But overall, circling back to what you're saying about jobs, everything seems pretty healthy right now. There is a little bit of tightening in a few labor sectors, but overall, I mean, looking just at preliminary numbers, we are speaking on Thursday right now. The big jobs report for January comes out tomorrow. You probably, if you're not watching live right now, you probably won't catch this podcast until after the jobs number comes out. But I mean, job openings are still pretty big. I think I read that right now there are 1.9 open jobs for every unemployed person. That was the report for December. That came out in the JOLTS report. So I think the numbers that come out tomorrow are really going to sway or have a significant effect on what happens March. But I'm still thinking, yeah, we see another 1/4 point hike.
Well, maybe I can get this out before it, because I'll give my hot prediction, man. Like the second best thing, if you're like looking for a bull case for stocks, like the second best thing to happen would be like the number comes in right in the screws. The worst thing that could happen is that it blows it out of the park. It's like a great unemployment number. And the best thing that could happen is it's like a terrible unemployment number. This is highly unlikely to happen. Markets like certainty, but I bet you this explodes into the stratosphere. If like the unemployment number were to come out at something absurdly high or just like above the whisper number or whatever that, it would be like, it's on. Like the bond traders are ready to say, yeah, Powell, like you're doing this. And to what you alluded to early, I've seen a lot of hedge fund guys who are putting big probabilities, right, on cuts before the end of this year. And I think that's predicated on that eventually holding a rate here will have a toll on deterioration. And as a country, we don't tolerate, you've seen that we don't tolerate inflation well, right? People get friggin' mad. Unemployment, if you were around in like 2008 or 2009 and stuff, rising unemployment is not something that people stand for at all either. They get mad. And that was only what, like nationally probably raised to like 7-8% during the Great Recession. Right. So it's a long way to go, but I think they'll start cutting if they get enough deterioration.
Another question I saw posed in an article I read was, could this be the first recession where the jobs market is not really affected?
Possibly. We don't know, man. This is all freeform jazz from here on out. I mean,
Mhm.
everyone's making these comparisons to this. I think people are being too confident in their own ideas of like what should happen. Especially like no one out there, very few people out there were actively trading in the late 70s, early 80s. And even if they were, it might be the wrong lessons. That was a totally different thing that happened. We've never had like an economy shut down completely at a
Mhm.
full halt and then a ton of money pumped into it. And then we let it reopen and see what happens. So I think we should be expecting things to move around back and forth. But I think these people who are saying like, you know, it's 1981 and we're going to 13%. It's like, shut up. We're not.
Yeah, I think I don't think the VIX would be below 20 if that were really the case. There's confidence in the market right now.
Oh, exactly. Yeah. With everything going on, once again, another thing you should have on your board, man. Keep track of the VIX. It's shocking. It's been a long time since we've had consistent VIX stuff below 20, and that should tell you something.
Mhm. We're still dealing with an inverted yield curve, though. That takes time to flatten out. But for the moment, shorter term rates are
Yeah, it's
higher than longer term rates.
and that's a function of the Fed, but it's like once again, every other time with the inverted yield curve, we just never had something like this before, where there's just this whipsaw, and we're trying to put down inflation in the short term. I don't think that 4+% yields on 6-month treasuries and 2-year treasuries is going to last too much longer.
Mhm.
It's like they're just waiting to work their way through like when the Fed stops cutting, or raising rates.
Keep rolling those 4-week notes until they tell you to stop.
Dude, I did today. I literally I was buying a bunch of, in the risk-free proportion of my portfolio, I was buying, 2 months out. It's like, oh, hey.
Yeah.
That's
I just checked actually. The 1 month, the 4-week note is trading, or the yield on the the yield on the 4-week note is 4.4% right now, almost 5%.
yeah, that I got close to that. And it's kind of like, yeah, if you have a bunch of money sitting
Just
around,
cash
like
sitting around.
in like a bank account, or I guess you'd need to be in a brokerage if you're going to do this. But like, yeah, if you got cash on the sideline, that's not bad for a month or two.
5% a month, not
Yeah,
bad at all.
Pay your cable bill. Yeah, I believe that's tax free, right, at the federal level. Maybe not
Is
for
it?
the.
No.
No, it is. I thought the coupons are,
Yes.
but those aren't coupon notes. Yeah, all good stuff to know out there. So, anyway, are there any important levels? We're selling off a little bit towards the end. Any other levels that you're looking at around here as we go into unemployment? And so for me, there's the big fat number at 4,000. The month high on that crazy CPI spike from December is at 4180 or thereabouts.
Yep.
4,200 is a big psychological one that I always hear as like that's a FOMO level for a lot of people, which then brings us to above that. 4326 was the last big rally, which kissed at that point the 200-day moving average, but didn't go through it like it has now. So
yep, we're looking at kind of the same stuff. That August high 4325, that's on my radar. After that, the big round number at 4,500. Those are some major levels that I'm looking at right now. Yeah, pulling up this chart right now. If you draw a channel line down from last year's highs to the October lows in the ES, you'll likely see that we've broken out of that upper channel line. We've clearly broken out of the bear trend. Doesn't necessarily mean a shift in overall trend, but there is some jockeying going on for longer term position right here. Today we tested that September high at 4175, like you said. We tested this level back in, I'm looking at it back in December too, just a couple of weeks ago. And we saw some sellers step in there. So this is a bit of an inflection point that we're at right now, going back to
Yeah.
September.
3,800 be huge too, because if you're looking back at the further, like on the year and a half level, we just have a series of lower and lower lows in 20, all these months are in 2022. I'm saying in January, in March, in May, in June, and then the lowest of the low we got like in October, kind of a double bounce. But now we're on 2 straight higher lows.
Mm-hmm.
So especially that 3,800 is kind of where the most recent low was. I think that is something that's going to be very important as well.
I agree with you there. Yeah, momentum's pointing higher. We've got strong volume coming in. Open interest is pointing is higher also. So these are all pretty solid bull signals we're seeing.
Yeah. So I guess the takeaway advice here is I would be less, like we said, 2022 in that down channel, it was kind of sell the pops and you'd usually do okay. We're kind of maybe rotating to a new, or we have to like a new, like when you go macro on this, a new state where I think it's establishing, yeah, like you said, bull trend.
Starting a shift possibly. That bear trend broke out of that channel from what I can see. That's the way I look at the market when I'm looking at these channel lines, of when it breaks out and it's consistently trading outside that upper channel line. It's more like a period of consolidation where longer term money is just battling for position right now.
So because it worked so well in 2022, I guess the parting piece of wisdom here is don't really, by all means, go short. If you have a strategy and you want to go short things, but don't get so committed to the idea of selling this, because that's the worst thing in trading, like the most deadly thing you can do is think things can't go higher, especially higher. And we are in one of those things at the beginning of the year. There's going to be FOMO. There's going to be a lot of, I saw someone else talking about that, a lot of traders. So a lot of like funds and things like that is that you can generally be forgiven for taking drawdowns during a bad year, but you're getting your ass canned if you miss out on rallies.
Yeah.
So around 4,200, that's my FOMO point. I'd be careful to just blindly short things as this goes through 4,200, just thinking that, oh, this looks expensive on a chart. It's got to be something more than that.
Don't let those overbought signals trick you into shorting too much. Death by 1,000 cuts, right?
Yeah. And remember all those, momentum algorithms out there and things like that. They love momentum. They don't love there's not a lot of contrarian algorithms out there. So cool. Well, JD, thanks for joining and kind of discussing this with me. This is kind of a timely episode. We'll maybe next week start a new series on something that's kind of more evergreen or whatever else, but it was just nice to talk about what's going on for now.
Yeah, that was awesome. Thanks for having me, Jack. I appreciate it.
Cool. Yeah. Stop by anytime. Everyone else out there, have a good day. Have a nice week. That's pretty broad. I gotta say something more specific, JD. It's may something nice happen to you in the next couple of days. Like a mitzvah. So stay safe, namaste, and trade well. We'll see you next week.